Hello, I'm Kevin Miller, the CEO and Portfolio Manager of the E-Valuator Mutual Funds. Today, we're going to go through part two of a two-part series that gives some perspective as to what happens on a daily basis with the management of these funds. Today, we're going to talk about the investment business cycle, the asset allocation zones, fundamental indicators, and any ongoing adjustments. In part one of this two-part series, we identified that the E-Valuator risk managed strategy funds are not typical mutual funds. They are an asset management service packaged inside a mutual fund. In part one, we identified that we use the E-Valuator software for selecting all the underlying investments inside each fund. We identified what our meticulous asset allocation process is. It's our map. We have also identified and discussed rebalancing and why that's beneficial during turbulent times. This part two of the two-part series is going to focus on economic responsiveness and optimizing our allocations. The investment business cycle consists of four phases. The economy contracts, it hits a bottom, then it begins to expand. It expands at too high a level, it'll hit a peak, and then it'll start contracting again. A contraction is identified as 2 consecutive quarters of negative GDP. Typically, expansions last much longer than contractions. The transition between contraction to expansion, or from expansion to contraction, that base or that peak can be relatively brief. To recognize these four phases, we created 8 asset allocation zones around them. Zone 1 would be a base phase. Zone 2 through 4 would be the zones that we would use during economic expansion. Zone 5 would be at the peak. Zone 6 through 8 would be the zones that we would apply during economic contraction. To help us determine what zones we're in, we track 7 leading economic indicators. These are the primary indicators we track. We also track an additional 14 more. So building permits, we want to see how the housing industry is doing and how it's expected to expand or contract based on the number of permits being filed. We look at manufacturing durable good orders. We monitor and track consumer confidence. We look at the spread between a 10-year treasury and a 2-year treasury. We track the S&P 500. It's a forward-looking index. We track unemployment claims. Are more people filing for unemployment, or are there fewer people filing for unemployment? And then we always monitor what the Federal Reserve is doing. So if the trend is rising very strongly, that would be a dark green arrow up. If the trend is just beginning to incline or beginning to taper, you would have an angled lighter green arrow. If it was flat, meaning it wasn't really moving, there was no trend, then we would have a yellow horizontal arrow. If the trend was beginning to decline or the decline was beginning to taper, it would be a lighter red arrow angled down. And if everything was dropping very strong, it'd be a dark red arrow pointing straight down. So when we look at the 8 asset allocation zones, we can see those 7 indicators inside each table. So if we look at the difference between table 3 and table 7, which are the 2 most extreme, table 3 would be something that we experienced in 2017, where the stock market went up every month of the year. Contrast that with zone 7, that would be very similar to 2008, where the stock market dropped a substantial amount over the course of that year. So if we look at zone 3, you can see building permits are rising, manufacturing orders rising, consumer sentiment is strong, the S&P 500 is going up, unemployment is dropping, Federal Reserve is raising rates, and the yield spread is expanding, but then beginning to tighten a little bit. Compared that to zone 7, where everything that was rising over here is dropping. The only thing that is going up would be unemployment. We have 6 strategies. Each strategy has a minimum and a maximum equity allocation. So an aggressive strategy, meaning heavier in stocks, would have a minimum of 85% in stocks, not to exceed 99% in stocks. A more growth-oriented allocation strategy would be 70% in stocks with a minimum, with a maximum of 85. If they had a minimum, if this strategy has a range of 70 to 85% in stocks, then it has a range of 15 to 30% in bonds. A moderate strategy would have anywhere from 50 to 70% in stocks and 30 to 50% in bonds. So you can see that every strategy has a predetermined minimum and maximum into equities and bonds, so we can invoke a rules-based approach to the asset management. This is how this plays out going back to our grid. Again, going back to zone 3 and zone 7, if we're looking more at a moderate strategy, you would see that our equity slider under zone 3 would be maximized because everything was going really good. The economy was expanding really strongly. So we want to participate in that as much as possible. The fixed income or bond side would be minimized. However, when we get into an environment similar to zone 7, the slider is going to move from maximum to minimum. The stock market is dropping. We do not want to participate that much in it, but we are always going to keep a minimum allocation into equities based on what we have put forth for each of these investments. In this case, we're saying we're going to always have at least a 50% holding in stocks and never more than 70%. We're always going to have a minimum in bonds, never more than a stated maximum. So not only are we looking at the sliding the equity allocation from minimum to maximum, but inside each asset allocation zone, we're going to be looking for different types of securities. So in zone 3, we'd be looking more for mid-cap companies, mid-sized companies, and large companies that are growth-oriented. Contrast that to zone 7 when the stock market's going down. Here we'd be looking for dividend-paying stocks and look at moving into them based on a value approach, meaning they're trading at an attractive value relative to what we feel the company is worth. The bond approach would be under zone 3, would be looking at short-term duration and probably looking at credit-oriented instruments like floating rate, bank loans, convertible bonds, maybe some emerging markets. In zone 7, when interest rates are going down, we'd want long duration, high quality. So not only are we sliding the equity and fixed income allocations back and forth, we're also looking at different types of investments, underlying holdings that would perform better in that economic phase. Bringing it all together, what you would see would be zone 3. If we saw all of these indicators performing in this manner, we would have the slider maximized over to the right for equities, minimized to the left for bonds, and then you could see the type of investments we'd be, categories of investments we'd be interested in retaining. As things slowed down and we were beginning to taper, then we'd be moving those sliders back a little bit. Once we felt we hit a peak, we'd have the sliders in the middle. When we saw a slow decline in the economy, then the sliders would be moved toward the left hand for equities would be moved to the left hand side, close to their minimum, but not all the way. So you can see with this how we're constantly moving things to make sure we're taking advantage of the trend and the momentum that the markets are providing for us. Across the 6 strategies, we have various focuses, whether it's high growth, income as secondary, or whether it's income as primary and stability of principal secondary. So we kind of identify that's a short-term loss tolerance for an investor that has a very high short-term loss tolerance. They would be more interested in aggressive type investing, where someone who has a very low short-term loss tolerance, they'd be on the other end of the spectrum, very conservative. In summary, the evaluated risk managed strategy funds offer 6 risk managed portfolios. They're driven by a MAP approach, which provides a pragmatic, rules-based approach to asset management. The asset management is packaged inside an open-end mutual fund. We seek to maximize return at the varying levels of risk across the efficient frontier. It's easy for investors to understand. They just simply identify their risk tolerance and they can go ahead and allocate their money into it. We have an open architecture environment. We're not committed to any single fund company. We use open-end funds and ETFs that are tracked by Morningstar. The oversight is done on a daily basis with due diligence and the flexibility to adjust accordingly. And we do have a strong performance record and a high level of investor acceptance. Here's the disclaimer on this presentation. I mentioned the S&P 500. It would consist of 500 domestic large cap stocks compiled by the Standard & Poor's. It is an index, and also standard deviation is a measurement of volatility. It does not guarantee future performance. Thank you.